Good morning, bulls and bears. Welcome to today's market update. I'll walk you through the key developments across the US dollar index, crude oil, spot gold, and Australian dollar against the US dollar. Let's start with the US dollar index, which weakened for a second consecutive session despite stronger than expected US non farm payroll growth in November. The economy added 64,000 jobs, beating expectations, but the unemployment rates rose to 4.6% from 4.4%. Most of the job gains came from non-cyclical sectors such as healthcare, which signal that the underlying cyclical momentum remains limited. Markets have interpreted this combination as reinforcing a cautious Federal Reserve outlook. While job growth remains positive, rising unemployment and soft labor demand support expectations for more aggressive rate cuts next year, with Fed funds futures still pricing in around 50 basis points of easing. Structurally, the dollar's weakness is not about economic collapse, but rather the fading of certainty. Previously, dollar strength rested on the combination of higher yields and superior US growth. Today, rate cuts are reducing yield appeal, while US growth resilience has yet to fully reassert safe haven demand. As a result, rallies are being sold, reinforcing a clear sell on rallies pattern. Technically, resistance is seen at 98.79, the 38.2% Fibonacci retracement, and near 98.83, the 14-day moving average. On the downside, support lies at the 98 psychological level, followed by 97.46. Turning to the energy markets, we can see crude oil has extended its nearly 2 week decline, breaking below $60 and touching an 11-month low near $55. This move reflects a broad repricing across the crude complex rather than isolated sentiment. The key driver has been rising expectations of easing geopolitical tensions between Russia and Ukraine. The prospect of relaxed sanctions reduces the geopolitical risk premium, potentially allowing Russian crude to re enter global markets more smoothly and lowering perceived supply risks. This decline represents a rapid clearing of risk and expectation premiums rather than a sudden collapse in supply demand fundamentals. As a result, price discovery has become more sentiment driven with increased volatility in spreads and term structure. From a technical perspective, the daily chart shows a clear downtrend with lower highs and lower lows. Momentum indicators remain bearish, with the moving average convergence divergence still dominant. However, the RSI near 41 suggests the market is approaching, but not yet at, oversold conditions, opening the door for a short term technical rebound. Key resistance is at $57.62, the 9-day moving average. On the downside, we need to watch for the $54.78 and $54 area. When considering spot gold, we can clearly see that it is trading around $4,340 per ounce, supported by a weaker dollar and slightly lower US Treasury yields. Despite mixed US labor data, the rise in unemployment rates has reinforced expectations for future Fed rate cuts, providing a tailwind for gold. The core bullish driver remains dollar weakness as a dollar priced asset, an alternative reserve store of value. Gold benefits directly when confidence in the dollar softens. However, rising long term yields, particularly the 30-year, remain a headwind for non yielding assets. Technically, gold remains in a strong uptrend with short term moving averages aligned bullishly. The RSI above 70 confirms strong momentum about MACD divergence suggests caution at elevated levels. As long as gold holds above $4,300 per ounce, a retest of $4,350 is likely, with potential extension toward the all time high at $4,381. Failure to break above 4,350 could trigger consolidation, with initial support at 4,271, followed by 4,260. Finally, the Australian dollar against the US dollar is trading near 0.66, consolidating after a strong recovery this year. Importantly, the Australian dollar's strength has been driven more by US dollar weakness than domestic outperformance. Structurally, the Australian dollar against the US dollar remains within an ascending channel on the daily chart, maintaining a bullish bias. However, near-term momentum is neutral as price hovers around the 10-day moving average. A break below 0.66 could open downside risk towards 0.6551, while upside targets remain 0.6685 followed by 0.6707 and potentially the channel top near 0.674. That's all for today's market overview. As always, stay disciplined with risk management, and I'll see you in the next market update.